Hi, I know you joined us a couple of weeks ago on, or I should say probably a month ago, not even a couple of weeks ago. Time flies by when you're on a lockdown during 2020, right? Sometimes it freezes, sometimes it passes by. We had a long-term care Q&A session and a lot of people were asking questions. And after that, I got a lot of questions about people wanting to self-fund. I have a lot of clients that are also self-funding. So really the big question at hand was, is there a way I can self-fund in a smarter way? Well, because I want to have access to my money where it's liquid and I don't want to give it up if I don't use it. So that's why I'm bringing Brian back really quickly to give you this little quick tip of, Brian, is there such a thing? And can you explain it to us a little bit?
Absolutely, and thanks. I'm always happy to talk to the clients at Confidence Wealth or people that are considering being clients. And the first thing I want to do is really just so everybody can understand what self-funding means. Self-funding is typically when somebody thinks, well, I have plenty of assets to pay for long-term care, and I'm just going to, spend down my assets over time to pay for that coverage. And that obviously is one way to do it. But there are some significant benefits with having a long-term care plan through an insurance company. And for example, well, one thing I want to talk about is if somebody does have significant amount of assets, there's a plan out there that, let's say you had $100,000 in a CD or a money market, is that you can actually transfer that over to your other pocket and get a long-term care plan, because this long-term care plan gives you 100% liquidity of the money. You can get at it at any time. It also gives you a death benefit, so at least that money is going to come back to your heirs. And thirdly, most importantly, it gives a long-term care benefit on top of it, which is significantly more than you actually put into your other pocket. So by transferring money from one pocket to another, you still have 100% liquidity, a death benefit in that amount or more, plus long-term care benefits. And that's really what we're looking for.
Okay, so the best example, I think, because sometimes we learn from example, Brian, the reason I brought this up is because you helped one of my clients where that's exactly what she did. She had extra cash sitting aside, 150,000, earning less than 0.1%. So now she has it in that policy that covers her for 7 years, giving her, I think, about 7,500 a month, something of that, approximately, give or take, and obviously
Plus,
tax free.
Plus, she has the inflation rider on that one too. So
Yeah.
the benefit does go up year by year, whether she's on claim or not,
Yes.
because obviously there's inflation in the
Yeah,
and
thank you for pointing that out. Absolutely, because she's in her mid 50s. So by the time she's 80, that 7,500 has grown to a lot more. And she always have access to that 150. The 150,000 she put in, she's always able to access it if she chooses not, that she doesn't want the policy and take the money back. And from what I learned was that if she doesn't use it at all, that 150 goes back to her heirs. Correct?
that's that's absolutely correct. Or if she uses just a portion of it, maybe she uses 75,000 or 80,000, then unfortunately passes away. So the balance of that 150 would go back to her heirs. So in every instance, either she or her heirs will have access and be able to have that money.
Yeah, and you know what's really funny is I'm supersizing my savings to this long-term care plan. And it was really funny because I didn't think about it that way because it's literally taking her cash and supersizing it for the cost of long-term care and have it always be available. Now, I know you said something also that it allows care coordination. So can you explain that a little bit to me?
Yeah, in fact, a lot of people that purchase long-term care that are very high net worth, they say, I really don't need this. But one of the main reasons I'm getting this is for something known as care coordination. And let me just ask a question to the audience is, let's say your doctor comes in and says, you're going to need assistance. You're either going to need home health care or nursing home. Who's the first person you call? I mean, if you ask your doctor that question, no, okay, what do I do now?
Yeah.
They are not experts in that particular area. Well, the carriers, most of the carriers, not everyone, but most of the carriers have what is known as care coordination services. And these care coordinators, what they do is they'll help you understand the benefits of your policy. They'll guide you through the claims process and also all the claims papers and forms, which can be very daunting. And they'll also give you indication or tell you where the best care is, because there's many nursing homes, especially in the greater LA area, but which ones have the best reviews, which ones have the worst reviews, the cost for them, so things of that nature. And they also work with your family to construct a plan so that it meets not only the family needs, but also your needs as well. So
Well, that's great.
that's just a few of about a dozen different benefits on care coordination.
Well, actually, you just mentioned the family. So will you, I was reading this blog about ultra wealthy families and why sometimes they use insurance. And it was interesting. And it's all about who, how is your care going to be, right? If it's covered by insurance versus if it's your assets. So can you go a little bit deeper into that and tell me like why someone who has money that can self-fund chooses to self-fund through a product like this? What's the purpose behind this coverage and where it leaves the family in a better situation?
Yeah, so let's just first summarize the fact that the care coordination for these wealthy people that can self-fund, the care coordination is
Yeah.
really, really good, because to rely on your family members to do that can be difficult, and then you may have some squabbling amongst the family members on how that care
Yeah.
coordination could do.
Daunting.
Now you have a third party doing that for you. Uh, One of the other things is private on these private nursing homes. The first thing they're going to ask you is, do you have private insurance? Because they want to be paid promptly. They don't want to, and the private insurance does. They pay promptly on time. Whereas if you're relying on a family member to make those payments, it may be delayed sometimes. And it's the only way I can say this is just giving you an example. I actually have a client that is in a nursing home right now, in a wonderful, wonderful nursing home, getting great care. And the son came up to me and he said, Brian, I'm so happy that she purchased that long-term care policy from me. I said, well, my hand. She says, because I would never have put her in such a nice place. And I said, why wouldn't you? This is your mother. He says, well, she's now spending my money, because he's
Ah,
looking from an inheritance standpoint. She's now spending my money, and maybe she would have been better, and maybe something that's much, a little bit less expensive. But,
interesting.
but instead, now she's got the best care possible, and he doesn't have to worry about his
Yeah.
money being spent. So
That's a
just
really good point. That's a really good point, Brian, because you're absolutely right. We don't think about this, but when it comes to money, people start thinking that way. And it may not be the son, it may be the wife, right? It could be
or the
anybody
in-law,
else.
the
That's what I mean. The
daughter-in-law.
in-law, the daughter-in-law. Yeah, that's what I mean. Exactly. That, hey, don't, why do you need your mom in such a nice nursing home? Because this is going to eat away 100,000 per year or 80,000 per year. And that's coming out of inheritance. So that's a really good point. Maybe this is exactly why the ultra wealthy uses insurance, so they can have the best care without the family interfering in the process. Oh,
Yeah.
that's funny. Money does make things,
Pe-
yeah.
yeah, people react differently when it comes to money.
Absolutely. So I'm excited that we got a chance to talk about this really quickly. I think it's so important for people to see and be educated, because obviously these also you have to qualify for. It's not like you can go in and they take everybody. So, Brian, what would you say would be the next step if someone is hearing this and they're like, this sounds like something I want to do. I'm going to self-fund through an insurance company with some of my own money. So what will be the best way for them to get a hold of you?
Yeah, the first thing we need to do is have a conversation. So the best bet is to give me a call at 424-273-8844. And if we both have time at that point in time, we can talk. If not, we can set up a time where it's convenient for both of us, and we'll discuss a custom plan specifically for you. And everything from, how much coverage you need, how much, assets, everything's customized for you individually.
Perfect. That sounds great. So learn about it. You have you have a go-to person, and you've been hearing Brian in the last Q&A session a few times. I have a lot of clients that love talking with him, and really he educates them very well. And I'm super excited that I learned about this particular plan, because I really like the fact that you don't lose your money. That's important. That's one of the things that we're always passionate about. Keep your hard-earned money and don't just give it up and in case you don't use it, right? So thanks, Brian, for being in this quick little tip of the week segment with us today.
Thank you.
Have a good one, everyone.